The Morgan Report with David Morgan.
David Morgan of themorganreport.com for the weekly perspective for the week ending September 2nd, 2022. Well, we had the second Silver Symposium this week, Tuesday and Wednesday. Fairly well attended, lots of companies, really stellar companies for the most part, and lots of interesting speakers. One speaker that we wish were there, or I do at least, was John Adams from Australia. He was unable to attend. And he has posted on his website from way back in June, Conquering Silver Market Manipulation. You can find it on his website, adamseconomics.com. I'm not going to read the whole thing. He talks about silver manipulation. And what he talks about primarily before he goes into his thesis is the, let's say, most verifiable and consistent way to look at the market manipulation. He talks about traditional precious metals analytical model. And what he goes through here is what you have all heard numerous times: central banks print more money or more fiat, leads to inflation and currency devaluation. This leads to economic agents shifting capital from fiat into hard assets. This shift generates additional investment. Additional investment demand drives up the price of precious metals. I think we've heard that more than once. Then he goes through and looks at data from the Silver Institute, which is in table form, and he talks about how much was bought. And this has been something actually brought to my attention by Steve St. Angelo before I looked at the data. And what it was significant, meaning that the amount of bar demand from retail in 2021 and projected for 2022 and in 2020 was very significant. And further, more significant, that in 2020 there was 331 million troy ounces in the ETP product. And Steve made a big deal about that, as he should. It was an astronomical amount relative to what the average has been for many, many, many years. In other words, it set a record. So the total was over 500 million. It was greater than the industrial demand, something we haven't seen. We did not see that in 2021, and I doubt we'll see that in 2022. So he has an alternative market thesis, and his thesis is what really happens if you buy silver, or especially in size. And he gives an example. If in addition 1 billion of investment demand for physical silver entered the market, but the investment was not actually backed by physical silver, even if the investor believed it to be, then this flow of fiat capital would have little to no effect on the market price. Think about that. So you're buying $1 billion worth of silver, and it has little effect. I mean, $1 billion worth of silver at $20 per ounce is about 1/20th of the market. That's considering the annual silver supply, which isn't 10% of the market, it's 5% of the market. It's still significant if you subtract the amount that's recycled, which is roughly 100 million ounces. It's more than that, but you're looking, 150. So you're looking at 850 million ounces, so maybe 7% of the market. Thus, a reasonable alternative explanation regarding the dynamics of the silver market suggests that the silver price is driven more by investment supply and not so much by investment demand. In the most extreme case, infinite fractional reserve supply, that is, silver bullion which doesn't exist, renders investment demand completely irrelevant as a price influencer. A new approach to silver market manipulation. And here he goes through, unfortunately, what happens with the amount of questions surrounding silver market, gold market, other markets as well. Certainly we've seen it in the oil market. We've seen it in other markets. In fact, so far as I'm concerned, this management of price manipulation, which is an overused word in my opinion, whatever you want to call it, is pervasive throughout all markets. It just happens to be, let's say, followed more in the precious metals probably than other arenas. Maybe interest rates are more. Anyway, talks about legal difficulties throughout the establishment. There's little hope that market manipulation can be tackled by attempting to expose and end the corrupt practices of the futures derivatives market by market participants such as bullion banks and those regulators who are charged with governing them. And he goes through and talks about, when these instances have taken place and what the results were. You can go back and see this class action lawsuit in December 2021, tune of $152 million of multiple financial institutions that were accused of being manipulative. I'll use that word. It include Barclays PLC, Scotiabank, Societe Generale, London Gold Market, and Deutsche Bank and HSBC and similar claims. So a bunch of banks didn't admit wrongdoing, they just paid a fine. JP Morgan found guilty and fined $920 million in 2020 by the U.S. Department of Justice for, he says, manipulating, I'm not sure they use that word, of precious metals market via the practice of spoofing. And he has footnotes here that you can check the validity of those statements. So let's pause here for a second. So 920 million divided by, I'm going to use $20 the ounce, even though we're under 18 right now as I'm making this video, is 46 million ounces of silver. Now, if you've watched any of the other commentators, and I've commented on this myself, I don't make comment on it every week, some do, that the amount of registered category in the COMEX is right now around 50 million ounces. So 46 million is pretty much going to wipe out everything that the dealers have currently in the registered category. But remember, they're paying 920 fiat. But let's say, for example, that the exchange did something like make whole what they did in silver. In other words, they had to fork over the silver, not the fiat. And that, again, would, in theory, and this is just a thought experiment, roughly the amount of silver that is held by the dealer community on the COMEX. Something to think about. And the last one, my favorite, not in terms of fines, because it was a very small fine, $4.4 million in a class action in 2007 for Morgan Stanley's for failure to purchase and store silver on behalf of investment clients. And that one was very interesting. I've brought that to the attention of my viewers more than once. And here's an article, as you can see, quite some time ago, April 2nd, 2011. Class action accuses UBS of charging storage fees for phantom silver. If you go through the article, which I've done, and it's a short read, you can look it up on coinweek.com and probably find it, is the following paragraph. A very similar lawsuit was filed in 2007 against Morgan Stanley. In that case, small investors were also claiming they had been defrauded into participating in an unallocated metal storage. The bank defended itself by alleging, among other defenses, that it was simply following standard industry practices. In other words, the amount of information given to the customers, the unallocated nature of the scheme, as well as the charging of storage fee for imaginary metal were standard industry practices. In light of what we know now, maybe they were telling the truth. Morgan Stanley did eventually settle for a multi-million-dollar payout, $4.4 million I just showed you, but it continued to deny liability. UBS has an answer, and that was as a date of April 2nd, 2011. So in conclusion, John states, from all objective evidence available, it's not quite obvious that the price behavior within the silver market over the past 2 years makes little market or economic sense. Instead, market manipulation offers a more compelling explanation. Despite historical attempts to address such manipulation, all previous attempts have either failed or resulted in cash settlements with no admission of wrongdoing and thus providing little incentive for market participants to alter their behavior. Rather, in order to effectively address market manipulation, what is required is a paradigm shift in approach and execution. This article argues that the only salvation for silver investors is to expose fraud and rehypothecation schemes within the physical market, which in turn exerts pressure on derivative exchanges via a bottom-up approach. Exposure of a sufficiently large scheme that proves scandalous is likely to trigger an international chain reaction that expedites the process of squeezing derivatives futures markets and manifesting in a higher, less manipulated silver price. So leave it at that. I am publishing the Morgan Report September edition later this weekend. We have a lot of interesting things in the opening statement, which is the editorial. I will be putting out a new recommendation for paid members probably in about 2 weeks. It's a company that's overlooked, very few know about. And I may also put on a trade at these very low prices. And it will probably be on the equity side rather than on the future side. So this is David Morgan with you from themorganreport.com, and I will be back with you next week for another weekly perspective.